Three numbers, just three numbers. That's all it takes now. Three numbers can decide whether you get approved for a house, a car, an apartment, sometimes even a job. And most people never stop to ask who invented credit scores in the first place. Because believe it or not, credit scores are actually a pretty recent invention. Before credit scores existed, banks judged people very differently. Back in the early and mid 1900s, getting a loan was often based on personal opinion. A local banker might know your family, know where you worked, know what neighborhood you lived in. And yes, sometimes people were denied loans based on race, religion, gender, or simply because somebody didn't trust them. There was no universal system, it was human judgment. Then in 1956, two men named Bill Fair and Earl Isaac came along and changed lending forever. They created a company called Fair, Isaac and Company, which later became known as FICO. Their idea was simple but revolutionary for the time. What if banks used math and statistics instead of personal opinions to decide who was risky to lend money to? At first, banks weren't completely sold on the idea. Computers were still pretty primitive compared to today. But over time, lenders realized something. The more data they collected, the more predictable people became financially. Then in 1989, the first modern FICO credit score rolled out nationally. And slowly, one number started following people everywhere. Banks used it, car dealerships used it, mortgage companies used it, landlords started checking it, insurance companies started looking at it. Even some employers began using credit history during hiring. And that's when credit scores stopped being just about loans and started becoming part of everyday life. Now, here's the weird part most people never think about. Credit scores don't really measure wealth. They mostly measure how well you manage debt, which creates a strange contradiction. Someone with no debt at all, who pays cash for everything, can actually have a lower score than somebody constantly borrowing money and paying it back on time. Think about that for a second. The system often rewards participation in debt itself. And once your score drops, life can suddenly become far more expensive. Higher interest rates, bigger deposits, more denials, more financial pressure, which can make climbing back out even harder. Now, to be fair, supporters of the system argue that credit scores removed a lot of human bias from lending decisions. And honestly, there's truth to that. But critics argue that a mathematical system created decades ago now has enormous control over modern life. And whether people realize it or not, those three little numbers can quietly shape where you live, what you pay, and what opportunities you even have access to. All from a system created nearly 70 years ago by two men trying to predict loan risk with statistics. And today, most people still don't fully understand how it works, even though it affects them constantly. That's the crazy part. The really crazy part.